For more on the markets, I want to bring in Liz Young, head of investment strategy at SoFi. Good morning to you, Liz. You heard what Mike just said. You agree with that? And what are you telling people to be doing at this particular moment?
Well, I liked what he said about detracting style points for what's happened in this rally. It's been the same old story. We had a couple days where we got excited that breadth had expanded, smaller cap stocks were participating, other sectors were participating, and then it reversed the other direction. And we again have mega caps really leading the way in this big spread among large caps and small caps. So although it's exciting to see a rally, and this period, if we did see the last hike in July, this period between the last hike and the first cut, the market does tend to hold up pretty well over that period, at least as far as history is concerned. So it's possible that we don't have anything catastrophic that happens in the meantime. What my concern would be is that as we continue to get inflation data that's cooling, and as we continue to get labor data that's cooling, what's happening in the rates market is that we're pulling the cuts forward. So those cuts, as the market expects, start to get closer and closer in time, which is exactly when the market usually gets a little trepidatious about the direction. So unless we have some bad news about inflation this week, it could again be kind of a quiet one. But I'm watching very closely what's happening with those expectations.
It sounds, and you're like almost stipulating that a cut is in the offing, that there's no chance of a raise at this point.
I wouldn't say there's no chance, but I do think that the chance of it is much more about messaging than it is about actually hiking. I don't know that there's really going to be much difference caused by another 25 basis points, even if they did do it. But they have to message that it's still on the table as an option and that they're still willing to do it if they have to. Because if you look at even the core measures of inflation, we know CPI core is still expected to stay at about 4.1% this week. If you look at core PCE, which is the Fed's measure, not expected really to come down much through the end of the year. So they still have to message that they're willing to do it if necessary. But I do think that the expectation of cuts not being until much, much later in 2024 or even 2025 is a little bit unrealistic, given that we already have so much tightening in the system, and the lag effects are starting to come through. So I think those cuts will get pulled forward.
If that's the case, then you're in a risk-on kind of environment. How do you think about some of the Magnificent Seven, if you will? Are they still magnificent in this kind of universe?
Well, the market has started reacting more rationally to the way that yields are moving. So you see this negative correlation back in effect in the sense that yields are coming down, growth stocks go up. That's rational behavior. However, if yields come down and we start to confirm or get more and more worried about recession actually being reality, then I think all stocks across the board, it turns into more of a risk-off market rather than risk-on. So we don't know the answer to that yet. Right. Until we know the answer and until we're still comfortable thinking that a soft landing is possible, then I do think that those Magnificent Seven stocks and growth stocks in general will still benefit from rates coming down. But as rates come down, as the yield curve re-steepens, and if they come down for fear reasons, I think risk in general gets hit.
Liz, we've had a number of folks come on, especially over the last couple of weeks, saying, you know what, as people are repositioning their portfolios, buy some bonds. And then on Friday, we heard from Ron Barron, who said that he's never owned bonds in his entire life or career. What would you tell people?
Well, we got a 2-year still above 5%, and that's a pretty good yield to be paid to sit around and wait and find out what's going to happen. So I would say, I think on the shorter end of the curve, it is an attractive entry point. And even a 10-year above 4.5, I mean, we've seen a pretty big drop in yields on the longer end of the curve. But if we are really worried about a recession, and if we're thinking that things will continue to cool, then I do think it's okay to have an allocation to bonds. I think that at some point yields will have to come down, even if we're in a higher for longer regime. They probably come down from this point, and at some point the yield curve does have to stop being inverted. So that would suggest that you see a rally in bond prices on the shorter end of the curve.